Introducing the Notary Chain UTXO Settlement Protocol, your gateway to secure compliant and transparent blockchain-based settlements. Harnessing the power of the ERC 3643 protocol and UTXO-based proof of funds, we deliver trust and legal certainty in high-value transactions. Our advanced cryptographic verification, zero-knowledge proofs, and hardware security modules ensure unparalleled compliance with global regulations. Experience near-instant settlement finality perfect for seamless cross-border transactions with reduced counterparty risks. Notary Chain integrates effortlessly with your existing financial frameworks using multi-signature verification and real-time threat detection. Discover the ALESC settlement framework and GoldBack token for legally enforceable asset-backed digital transactions. Built to meet stringent regulatory standards, our protocol provides unmatched security and efficiency for institutional clients. Join the future of settlement with Notary Chain and redefine trust in both traditional and digital asset markets today.
Imagine a financial ecosystem that moves as one, where AI, blockchain, and other advanced technologies streamline processing, where trade settled with certainty. DTCC makes it possible by purposefully innovating for the global markets. Faster, smarter, more connected. Markets are evolving. We help you access new opportunities so you can grow. The future isn't far away. We're building it today. DTCC, Financial Markets Forward.
Legacy paper diverges from physical reality. Eastern banks drain vaults while a Western closed loop traps premiums, around $97 and about $173 out. Family offices hold just 2% metals. Institutional entry points to $8,000 gold and $230 silver with real security and physical possession. RSI 4.0 replaces ex-post litigation with ex-ante engineering. Proactive code-based self-executing contracts where breach is impossible. A civil law notary acts as a sovereign node certifying animus, so intent aligns with automated execution, the law between the parties. Compliance becomes syntax. Basel III and FATCA enforced as code with on-chain document notary seal and jurat hashes gated by RBAC. Be value-centric. Trade ratios to stack ounces, use GoldBacks to bypass premiums, and never sell metal for dying currency. Run the ratio play and unlock liquidity via tokenized credit mining and non-recourse funding, while UTXO logic prevents double pledging and enforces awards instantly. Join the architecture of sovereign finance. Partner with Justice Fund and RSI 4.0 and verify the code today.
Welcome to the Money Metals Midweek Memo. News and commentary relating to sound money, the precious metals markets, and the economy. I'm your host, Mike Maharrey. Thanks for tuning in. Money is money, and paper is paper. All the inventions of man cannot make them otherwise. Those words were written by Thomas Paine in an essay where he went after what he saw as one of the greatest scams in history. Governments claiming that paper is money. It was a devastating critique, and Paine delivered one of the most brutal takedowns of paper money ever written. He systematically exposed every aspect of what he called a fundamental fraud. Paine started with the simple truth that cut through centuries of propaganda. Gold and silver are the emissions of nature. Paper is the emission of art. And he went on to explain that gold and silver have one of the qualities necessary for real money, because its value must come from a source outside of human control, making it stable and trustworthy. Paine wrote, "The value of gold and silver is ascertained by the quantity which nature has made in the earth. We cannot make that quantity more or less than it is, and therefore the value, being dependent upon the quantity, depends not on man. Man has no share in making gold or silver. All that his labors and ingenuity can accomplish is to collect it from the mine, refine it for use, and give it an impression or stamp it into a coin." Paper, Paine argued, fails as money because it lacks this quality, among other qualities. He wrote, "Paper considered as a material whereof to make money, has none of the requisite qualities in it. It is too plentiful and too easy to come at. It can be had anywhere and for a trifle. Now, unfortunately, the powers that be did not listen to Thomas Paine, or maybe they did, and they realized that the dream of big government is impossible with sound money. Governments need to be able to print money at will to support borrowing and spending. A big welfare state, a big warfare state requires money printing. In a fiat system, the government can levy the inflation tax on the people. And since most people don't notice inflation, at least not immediately or unless it gets too bad, it's a lot easier for government to get away with taxing them, right? They're not noticing it. It's not like the tax collectors coming and banging on their door. They're just stealing the value of their money. So gold and silver are sound money. You should read that essay. I'll link to it on the show notes page. It's a really good explanation from Thomas Paine about why paper fails as money. But gold and silver, money. But unfortunately, people out there in the investment world, they didn't pay any attention to Thomas Paine either. And they have turned the gold and silver markets into a paper market. Now, it's not exactly the same as fiat, but the impacts are very similar. And we're seeing this manifest in the silver market today. So what I want to talk about today is I want to delve a little bit into the paper silver market versus the physical silver market. But first, I do want to thank you for listening to the show. As always, I really, really appreciate it. Appreciate a couple of folks who reached out and hoped I was feeling better after trying to do the podcast with a bad cold last week. I appreciate that. I feel much better. I think you can probably tell from my voice. Not 100%, but definitely better than I was. So anyway, I do appreciate you listening to the show. And as always, would really appreciate it if you would share these episodes and write a good review for us. Give us those thumbs up wherever you're listening to the show. That will help grow the show and spread the word. And if you're getting some value out of it, maybe other folks will as well. So again, thank you. I do appreciate it. And, while we're on the subject of silver, I do want to call your attention to the fact that we do still have junk silver at below spot price. And when I say junk silver, I'm talking about quarters, dimes, half dollars that were minted prior to 1965. These quarters, dimes, half dollars, they're 90% silver. So the melt value is worth way more than a quarter. And we still have junk silver on sale at below spot price. It's a great way to invest in silver if it's something that you're thinking about doing. And I think now's a good time, right? We've had this correction in the silver price. We're trading below $80 an ounce. And I think that we still have a lot of upside for reasons that we're going to discuss today in the show. So keep that in mind and remember that we do still have junk silver at below spot. And we have some other specials as well. If you just go to moneymetals.com and you click on that specials tab, you'll see the bargains that are available. So let's talk about the silver market. Paper silver has basically driven the market for years, but with metal in short supply, physical demand is starting to exert control over the market. So what do I mean by paper silver? I'm talking about the futures market, right? People have contracts. The contract is basically for, say, 30 days. And in that contract, it says, we're going to deliver X amount of silver at this price at some point in the future. So it's a futures contract. It's paper. And the problem is there are a lot more of these future contracts out there than there is actual metal. So, you kind of have, 4 paper contracts and 1 silver bar, and they're all kind of laying claim to that silver bar. Now, the idea is that not everybody's going to want to take delivery, so it'll be fine. And generally it is fine, but it has become much less fine over the last few months, as we're going to discuss. So I'm sure that folks that are listening to this show are pretty savvy on what silver has done, but let's recap. After briefly skyrocketing to $120 an ounce in January, the silver price has corrected and it's retreated to the $75 range. And I think it's around $77 today. We're up. We're still seeing a lot of volatility in both the gold and silver markets with big price swings as people kind of try to figure out what's going on after that big correction. But running between $75 and $80. However, even with the correction, one of the fundamentals driving silver to that record high remains in place. And that's the simple fact, and I hammered on this in the show, I've hammered on this in the writing, there simply isn't enough physical metal to meet all of the demand. And analyst David Morgan, he's the publisher of the Morgan Report, and I've interviewed him several times for our podcast recently, just a couple of weeks ago, and I'll link to that interview on the show notes page. David Morgan's fantastic analyst. He is a macro analyst, so he's looking at the big picture. And he was recently interviewed by Kitco News, and he said some really interesting things that I'm going to kind of use to tie this discussion of the silver market together. And what he said is that physical demand is beginning to exert dominance over paper-based pricing mechanisms. Now, let's talk a little bit about this paper-based pricing mechanism. I gave you the quick overview. Just how much more paper is there than actual silver? Well, according to analyst Faisal Amin, or probably Amin, and this was published by FX Street a while back, the paper to physical ratio is somewhere near 356 to 1. So in other words, for every ounce of physical silver in the world, there are 356 paper ounces. So a lot more paper out there. And when you look at the mechanism, it's really no different than fractional reserve banking, right? So in fractional reserve banking, a bank doesn't have to have $100 to loan out $100. It only has to have $10, right? It only has to have a fraction of what it's loaning out in reserve. So again, as long as everybody is content to keep their money in the bank, the system hums along quietly. But when people lose faith in the bank and they demand their dollars, you end up with bank runs. So similarly, when people demand delivery of physical silver, the paper system gets shaky. And ultimately, if enough people want to take delivery of that physical silver, well, then the whole system's going to collapse, right? Because there are a lot more people with the paper making demands to have their silver than there is actual silver to fulfill all of that demand. As Amin put it, quote, silver prices are not just reacting to demand right now. They are reacting to the realization that the market's underlying structure is no longer credible. So looking at the official COMEX depository data, and this is as of February 11th, and just to be clear, the COMEX is kind of the center of the futures trading, particularly in the West. So you have various centers of the silver market. You've got New York, you've got the COMEX, you've got London, and you've got Shanghai. And so looking at the COMEX depository data, and again, this is where a lot of the futures trading is centered. Total registered silver stocks have dropped below 100 million ounces to 98,138,005 ounces. So dropping below that 100 million threshold is pretty significant. Now, what do I mean by registered silver? Well, registered silver simply is what is officially available for delivery against a futures contract. So in a COMEX vault, you will have both registered and eligible silver. And eligible is silver that is owned by ETFs and other financial institutions that's being stored in the vault, but it is not available for delivery. And interestingly, an additional 4.7 million ounces were actually withdrawn from the eligible category based on the last COMEX report, which tells you that people are trying to let go of that silver and making it available for delivery because there's so much physical demand. So David Morgan told Kitco News that this drawdown in COMEX holding indicates that the global silver market is under stress. He said, quote, the physical market is taking control over whatever the paper price is. And where we're really seeing this physical demand is in Asia, both from investment and industrial demand. Keep in mind, a lot of the electronics, the solar energy production, a lot of that is based in China and in India. So we're seeing this really strong physical demand in the East. And this is exacerbating of metal. And we see we cannot make that quantity more or less than it is. And therefore, the value being dependent upon the quantity depends not on man. Man has no share in making gold or silver. All that his labors and ingenuity can accomplish is to collect it from the mine, refine it for use, and give it an impression or stamp it into a coin. Paper, Payne argued, fails as money because it lacks this quality, among other qualities. He wrote, paper, considered as a material whereof to make money, has none of the requisite qualities in it. It is too plentiful and too easy to come at. It can be had anywhere and for a trifle. Now, unfortunately, the powers that be did not listen to Thomas Paine, or maybe they did, and they realized that the dream of big government is impossible with sound money. Governments need to be able to print money at will to support borrowing and spending. A big welfare state, a big warfare state requires money printing. In a fiat system, the government can levy the inflation tax on the people. And since most people don't notice inflation, at least not immediately, or unless it gets too bad, it's a lot easier for government to get away with taxing them, right? They're not noticing it. It's not like the tax collectors coming and banging on their door. They're just stealing the value of their money. So gold and silver are sound money. You should read that essay. I'll link to it on the show notes page. It's a really good explanation from Thomas Paine about why paper fails as money. but gold and silver, money. But unfortunately, people out there in the investment world, they didn't pay any attention to Thomas Paine either. And they have turned the gold and silver markets into a paper market. Now, it's not exactly the same as fiat, but the impacts are very similar. And we're seeing this manifest in the silver market today. So what I want to talk about today is I want to delve a little bit into the paper silver market versus the physical silver market. But first, I do want to thank you for listening to the show. As always, I really, really appreciate it. Appreciate a couple of folks who reached out and hoped I was feeling better after trying to do the podcast with a bad cold last week. I appreciate that. I feel much better. I think you can probably tell from my voice. Not 100%, but definitely better than I was. So anyway, I do appreciate you listening to the show. And as always, would really appreciate it if you would share these episodes and write a good review for us. Give us those thumbs up wherever you're listening to the show. That will help grow the show and spread the word. And if you're getting some value out of it, maybe other folks will as well. So again, thank you. I do appreciate it. And, while we're on the subject of silver, I do want to call your attention to the fact that we do still have junk silver at below spot price. And when I say junk silver, I'm talking about quarters, dimes, half dollars that were minted prior to 1965. These quarters, dimes, half dollars, they're 90% silver. So the melt value is worth way more than a quarter. And we still have junk silver on sale at below spot price. It's a great way to invest in silver if it's something that you're thinking about doing. And I think now's a good time, right? We've had this correction in the silver price. We're trading below $80 an ounce. And I think that we still have a lot of upside for reasons that we're going to discuss today in the show. So keep that in mind. And remember that we do still have junk silver at below spot. And we have some other specials as well. If you just go to moneymetals.com and you click on that specials tab, you'll see the bargains that are available. So let's talk about the silver market. Paper silver has basically driven the market for years, but with metal in short supply, physical demand is starting to exert control over the market. So what do I mean by paper silver? I'm talking about the futures market, right? People have contracts. The contract is basically for, say, 30 days. And in that contract, it says, we're going to deliver X amount of silver at this price at some point in the future. So it's a futures contract. It's paper. And the problem is there are a lot more of these future contracts out there than there is actual metal. So, you kind of have, 4 paper contracts and 1 silver bar, and they're all kind of laying claim to that silver bar. Now, the idea is that not everybody's going to want to take delivery, so it'll be fine. And generally it is fine, but it has become much less fine over the last few months, as we're going to discuss. So I'm sure that folks that are listening to this show are pretty savvy on what silver has done, but let's recap. After briefly skyrocketing to $120 an ounce in January, the silver price has corrected and it's retreated to the $75 range. And I think it's around $77 today. We're up. We're still seeing a lot of volatility in both the gold and silver markets with big price swings as people kind of try to figure out what's going on after that big correction, but running between $75 and $80. However, even with the correction, one of the fundamentals driving silver to that record high remains in place. And that's the simple fact, and I hammered on this in the show, I've hammered on this in the writing, there simply isn't enough physical metal to meet all of the demand. And analyst David Morgan, he's the publisher of the Morgan Report. And I've interviewed him several times for our podcast recently, just a couple of weeks ago, and I'll link to that interview on the show notes page. David Morgan's fantastic analyst. He is a macro analyst, so he's looking at the big picture. And he was recently interviewed by Kitco News, and he said some really interesting things that I'm going to kind of use to tie this discussion of the silver market together. And what he said is that physical demand is beginning to exert dominance over paper-based pricing mechanisms. Now, let's talk a little bit about this paper-based pricing mechanism. I gave you the quick overview. just how much more paper is there than actual silver? Well, according to analyst Faisal Amin, or probably Amin, and this was published by FX Street a while back, the paper to physical ratio is somewhere near 356 to 1. So in other words, for every ounce of physical silver in the world, there are 356 paper ounces. So a lot more paper out there. And when you look at the mechanism, it's really no different than fractional reserve banking, right? So in fractional reserve banking, a bank doesn't have to have $100 to loan out $100. It only has to have $10, right? It only has to have a fraction of what it's loaning out in reserve. So again, as long as everybody is content to keep their money in the bank, the system hums along quietly. But when people lose faith in the bank and they demand their dollars, you end up with bank runs. So similarly, when people demand delivery of physical silver, the paper system gets shaky. And ultimately, if enough people want to take delivery of that physical silver, well, then the whole system's going to collapse, right? Because there are a lot more people with the paper making demands to have their silver than there is actual silver to fulfill all of that demand. As Amin put it, quote, silver prices are not just reacting to demand right now. They are reacting to the realization that the market's underlying structure is no longer credible. So looking at the official COMEX depository data, and this is as of February 11th, and just to be clear, the COMEX is kind of the center of the futures trading, particularly in the West. So you have various centers of the silver market. You've got New York, you've got the COMEX, you've got London, and you've got Shanghai. And so looking at the COMEX depository data, and again, this is where a lot of the futures trading is centered. Total registered silver stocks have dropped below 100 million ounces to 98,138,005 ounces. So dropping below that 100 million threshold is pretty significant. Now, what do I mean by registered silver? Well, registered silver simply is what is officially available for delivery against a futures contract. So in a COMEX vault, you will have both registered and eligible silver. And eligible is silver that is owned by ETFs and other financial institutions that's being stored in the vault, but it is not available for delivery. And interestingly, an additional 4.7 million ounces were actually withdrawn from the eligible category based on the last COMEX report, which tells you that people are trying to let go of that silver and making it available for delivery because there's so much physical demand. So David Morgan told Kitco News that this drawdown in COMEX holding indicates that the global silver market is under stress. He said, quote, the physical market is taking control over whatever the paper price is. And where we're really seeing this physical demand is in Asia, both from investment and industrial demand. Keep in mind, a lot of the electronics, the solar energy production, a lot of that is based in China and in India. So we're seeing this really strong physical demand in the East. And this is exacerbating the displacement of metal. And we see this in the silver benchmark price in Shanghai, which is currently running a premium of around $10 an ounce over the Western spot price. So in other words, that silver benchmark price in China is $10 higher. That's telling you that there's not enough silver in that area. So the premium's higher. And the idea is that the arbitrage opportunity will draw silver out of the West towards those Asian markets. But there's not a lot of silver to move because silver supplies in London have been tight for months. And, you know, this started last spring, so almost a year ago now, when tariff worries incentivized the movement of silver out of London vaults to the U.S. And this was all due to worries about the tariffs. An explosion in Indian silver demand this fall was kind of the straw that broke the camel's back. And it led to the first round of what I call the silver squeeze, and that pushed prices above $50 an ounce for the first time ever. And initially, as Indian demand spiked, buyers were primarily sourcing their silver from Hong Kong, but they reportedly shifted more toward London during the Chinese Golden Week holiday in the first week of October. And at that point, London vaults were already tapped out. So prices skyrocketed. Silver moved from New York to London, and that eased some of the pressure. But the problem fundamentally cannot be solved by shuffling metal from one place to another, right? Because we have that fundamental problem. There simply isn't enough silver. So while the COMEX is primarily centered on the futures market, the Shanghai market is more oriented towards industrial users. As David Morgan put it, quote, "It's certainly a futures market, but not to the extent London and New York are, which means a lot of that silver that's in inventory or on exchange is going to be taken by somebody for purposes of either investment or industry." And of course, this drain of silver out of Shanghai vaults is creating tight supplies. And the price difference, as I've already mentioned, should incentivize a flow of metal from the west to the east. However, Morgan said that logistics and capital controls are creating friction in the market. And he said, obviously, if you're willing to pay more than the benchmark price in New York, it's going to be flown over to China. But the spread hasn't closed. Something's up. And I think that something is that there just isn't enough metal in London to facilitate that movement, right? You add on top of that the logistics and the capital controls that Morgan already mentioned. Well, you have a very tight, sticky market. And Morgan pointed out that this big demand for physical metal in China is requiring 1,000-ounce bars, which is typically the domain of the COMEX. These are commercial bars, and they're generally what is used in a futures contract. And Morgan likened retail demand to a flea on a dog compared to the tail on a dog. He said, quote, "Once the industrial needs were not met, you saw that the physical market took over the silver price. That has happened very sporadically in the past. This time, it was the real deal. We saw something that we haven't seen in a long time. We saw the silver price in 2025 go up 140%. And then we saw a 70% increase in a single month in January." Now, I kind of want to go back to this idea of the 1,000-ounce bars, because I think it's interesting. Money Metals had a bunch of 1,000-ounce silver bars in the vault, and actually saw them when I was in Idaho a while back at our facility. And it's pretty cool. 1,000-ounce silver bars, like a pallet of them was worth well over $1 million. And this was before the big jump in silver price. And we actually sent some of those 1,000-ounce bars to India. So this just kind of reiterates, we're a retail company. We're not typically involved in these big futures trading and whatnot. But there was so much demand that we did send several pallets of 1,000-ounce bars over to India. So that just goes to show how strong the physical silver demand has been. Morgan emphasized that, fundamentally the silver market is still a derivatives market. It's still a futures market. And what happened is it's gotten significantly overextended over the last several months. Quote, "The paper price, the paper paradigm took over. So temporarily, even though the 1,000-ounce bar market had basically taken control for weeks, perhaps months, and everybody was kind of cheering that who understood what was really happening, it didn't negate what was going on in the futures exchanges around the world. They go ahead of themselves." And Morgan said that kind of eventually brought things back to reality. We saw the price correction. We're back down to, $75, $80 an ounce, and that's where we are today. And I think Morgan really sums it up. Now we are in a struggle between who's going to win at this point. And it could go back and forth a couple of more times. Is it the paper pushers or is it the physical demand? So, I'm of the opinion that eventually in a system like this, physical demand wins, right? How much silver is there? That is the absolute key. So we're seeing all of this demand for physical silver in the Shanghai market. I've already mentioned the fact that there's a lot of demand in India as well, and this is adding to that demand pressure. And we're talking both investment and industrial demand in India. And investment demand has really grown over the last several months. And I think a lot of that is because the price of gold has gotten so high, and a lot of poorer folks in rural areas are turning to silver because it's more affordable. They can still preserve and protect their wealth, but they can't, afford to get into gold, so they're turning to silver. So we're really seeing this boom in demand in India. Then we can add another thing to the mix. We have policies at the COMEX that are kind of altering the market. The CME Group recently raised margin requirements, meaning that traders have to put up more upfront money when entering into a futures contract. And Morgan said, quote, "The higher margin goes, the more we're forcing a cash-only market." Adding that higher margin requirements create a natural break on speculative rallies by flushing out highly leveraged traders. So that's probably a little bit more of what we've seen underlying the recent correction, right? These highly leveraged futures traders are taking advantage of the lower price to get out of their shorts. And again, this is adding even more pressure in the market. Now, all of this is playing out in an environment where physical silver demand is outstripping mining and recycling supply year after year. Based on preliminary data compiled by the Silver Institute, silver demand outstripped supply by about 95 million ounces last year. It was the fifth straight market deficit. So when we put those 5 years together, the total deficit was above 800 million ounces. That's an entire year of silver mine output. And the Silver Institute projects the sixth market deficit will be this year of around 67 million ounces. That's even with higher prices creating headwinds for industrial demand. So with the supply of metal limited, this battle between the paper and physical markets is likely going to continue. That means you can expect more price volatility. Don't be surprised if you see big daily swings both up and down as these markets kind of wrestle with each other. But I think as you watch the market progress and as you think about the midterm or the longer term, it's important to keep in mind one crucial fact. They can create paper to their heart's content. They cannot create metal. And just like sound money will always win over fiat in the end, I believe the physical market will eventually overpower the paper pushers. Metal, the market is about the metal, right? How much metal is there? That's the thing that I think it's important to keep your focus on. So that's the silver market. I suppose before we wrap up the show, I probably should mention the CPI report that came out last Friday. Although honestly, when I talk about inflation, I feel like a broken record because everything that I say is so counter to what you hear in the mainstream news. But alas, I think it is one of the most important factors to consider if you're a gold or silver investor, right? Inflation is fundamentally about your money, and your money is broken, right? That's what Thomas Paine was writing about. Go back and read that essay if you get time. It's worth reading because this is exactly what he was talking about. So we have this inflationary environment. Gold and silver are an inflation hedge. So it's very important, I think, to look at inflation and monetary policy and what the Fed is doing because it has an oversized impact on the economy. So let me just put it succinctly. Just because prices aren't rising as fast as they were a year ago doesn't mean that inflation is dead and gone. Now, of course, if you listen to the financial media reporting on the January CPI, you're going to get the impression that the Fed has slain inflation. It was great report, great news. I read one reporter, I think she was on CNBC, and she was talking about how this is going to be a boost for the middle class because they're not having to, fight these rising prices. So yeah, the Fed's won, right? No, it hasn't. Okay, so let's look at the numbers real quick. The headline annual CPI fell to 2.4%, and that is getting close to the mythical 2% target. Yay for them, right? But think about it. The goal is to steal 2% of your purchasing power every single year. That's more than 10% of the value of your dollar eroding every 5 years. That's the plan, right? That's what they're shooting for. Right now, we're above that, so it's worse than that. But what they're shooting for is still inflation. The bottom line is there is always inflation. And there is more inflation than that CPI data reveals. The CPI is not really a very good way to gauge inflation, to be quite honest. It's the money supply, and the money supply is at record levels, and it's rising. This is, by definition, inflation. So remember, and I hammer this point over and over again, and I'm going to hammer it as long as I've got a voice and a microphone. Technically speaking, inflation is an increase in the supply of money and credit. That used to be what they meant when they said inflation. Rising consumer prices, measured by the CPI and other metrics, are just one symptom of monetary inflation. Monetary inflation can manifest in other places. You know, it doesn't necessarily show up in consumer prices. In fact, it usually doesn't show up in consumer prices first. It usually shows up in assets like the stock market or real estate, because the first people who get this newly created money are the bankers, right? So it makes sense that banking kind of things, these assets are going to pump up first. So we see this inflation in the stock market. We see it in real estate. We see it in art. We see it in all kinds of things. And it can also show up in consumer prices. And really, what else is going on in the economy, other policies can really dictate how that inflation manifests. But here's the thing, inflation is always bad, right? Just because it's not showing up in consumer prices doesn't mean it's okay. So when you hear the CPI report, you probably should take it something like a thermometer, right? It can tell you if you have a fever, but it can't tell you what's causing it. Now, if you listen to the politicos and the pundits, you might think that tariffs cause inflation. Or maybe it's greedy corporations. Perhaps it's Putin's fault. Remember Putin's price hikes? Or, maybe it's just unicorns waving magic wands, and that causes prices to go up. Wrong, 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 and wrong. It's the money printing, stupid. Right? Inflation is an increase of the supply of money and credit. And who incentivizes the increase in the supply of money and credit? It's the Federal Reserve through literal money printing when they operate quantitative easing, or indirectly by cutting interest rates, making interest rates artificially low, and increasing the money supply via bank lending. So as the Federal Reserve revs up the money-creating machine even higher with rate cuts and stealth quantitative easing, the money supply is already growing at the fastest rates since July 2022, which was the early stages of the Fed tightening cycle. After peaking in April of 2022, the money supply actually began to decline as the Fed hiked rates that year. And they also began shedding some of the assets from its balance sheet. So we had quantitative tightening and rate cuts. And so the money supply dropped. It was sucking liquidity out of the system, which is exactly what it's supposed to do. And the money supply bottomed in October 2023, and then it began increasing again. So we've had inflation since 2023. Now it's accelerating, and it is well above the pandemic peak. So as I've already alluded to, we also know inflationary pressures are increasing because the Federal Reserve is once again expanding its balance sheet through quantitative easing. Now, you're never going to hear anybody at the Fed utter the term, right? But the central bank did relaunch QE back in December. So that means they are once again buying U.S. Treasuries using money created out of thin air. Again, this is by definition inflation. How's it going to manifest? Is it going to manifest in asset prices in a skyrocketing stock market, or real estate inflation, or consumer prices? Hard to tell, but there is inflation. So my point is there is still plenty of inflation. That means you need to hold real money to protect your wealth. You need gold and silver because money is money and paper is paper. right? So now, if this is your first time listening to the show, you might be asking yourself, well, Mike, why are people still screaming for interest rate cuts and looser monetary policy if inflation is on the rise? Why would the Fed do that? Well, because as I've been saying for months, the Fed is in a catch-22, right? It needs to cut interest rates and run quantitative easing to support the debt-riddled bubble economy. You got to feed the debt black hole. But the economy also needs higher rates to keep price inflation under control. Obviously, the Fed can't do both. It has to choose. It is choosing inflation. Any cooler than expected CPI report will throw more fuel on the easing fire and raise the possibility for more rate cuts this year, despite the central banker's efforts to tamp down expectations for future easing. So in other words, you get more inflation despite what the CPI data might indicate. Okay, I've got one more question for you before we wrap up the show. Would you take investment advice from a 10-year-old girl? Now, you probably reflexively answered, no. Well, maybe you should reconsider that answer. One little girl in China sets the intelligence bar pretty high. In fact, people are calling her a genius based on her investment savvy. 3 years ago, so when she was 7, she started buying gold with her Lunar New Year lucky money. So let me give you a little context. On the Chinese Lunar New Year, which was actually yesterday, February 17th, Chinese adults traditionally gift children with red envelopes containing, quote, lucky money. I have the Chinese words here. I'm not going to try. So the girl's mother, I think you pronounce it Bai, said that the young lady receives about 4,000 yuan each year. So that's about $580 at the current exchange rate. So that's a pretty good little chunk of cash every year for a 7, 8, 9-year-old girl. Bai said the little girl started investing her lucky money in gold because she was worried that her parents might get the money and spend it. So revealing wisdom way beyond her years, the girl expressed belief that gold is easier to preserve than cash. Now, she was worried about her parents taking her money, but, big picture, she's absolutely right? One of the reasons to hold gold is its role as a safe haven and as a secure way to store your wealth. You got to be pretty impressed with this young lady's perceptiveness. Now, of course, it's highly unlikely that this little girl understands that the government is more of a threat to her lucky money than her parents. The Chinese is as fond of monetary manipulation and currency devaluations as its counterparts in the West. And as fiat currency loses purchasing power, the price of gold rises. Now, she might not be able to articulate this. She probably can't. But she learned this lesson in economics through experience. When she first bought her gold, it was around 460 yuan per gram. By this past February, the value of her gold had surged to $1,100 yuan. That's a 139% return on her investment. Most financial planners would kill for that kind of return. Bai said that her daughter has accumulated around 30 grams of gold. It's interesting because in China, 1 gram gold beans are very popular. They're affordable. So a lot of folks will buy these little 1 gram beans and you'll see jars holding these gold beans. And so she's got around 30 grams. Her mom said she hasn't sold any of it, not even when prices plunged during the correction in late January. In fact, her mom said this little girl plans to buy more gold. So like I said, might not be a bad idea to take investment advice from a 10-year-old girl, at least this particular 10-year-old girl. And if you're thinking, you know what, I need to get some gold because I know the government is devaluing my money every single day, and it is. I need silver. I need gold to protect and preserve my wealth. You can do it. Call 800-800-1865. Talk to a money metals, precious metals specialist today. If you have questions, if you want to know how, when, what, they can answer those questions for you. These folks are fantastic. They're knowledgeable. They love talking about gold and silver. They'll help you figure out how you can fit precious metals into your investment strategy and on your budget. Now, if you don't want to talk on the phone, you don't have to. You can go to moneymetals.com and chat with a precious metals specialist online. Or if you know what you want, and I would advise this because we're still getting pretty high call volume, you can just go to moneymetals.com and purchase the things that you want to purchase. You want to get some, gold eagles. Well, you can just search for those. You can find them on the website, order them. We'll package them up. We'll ship them out to you, or we can store your metals in our state-of-the-art bullion depository. But act now. We've had a correction. We've got gold trading a little bit below $5,000 an ounce. We have silver below $80 an ounce. I think these are buying opportunities. I've talked about ad nauseum why I think that we're in a long-term gold market and we shouldn't be scared off by these corrections. So I view price drops as a buying opportunity. So you want to act, strike while the iron's hot, as the sayings go. So do it today, 800-800-1865, moneymetals.com. So that is a wrap for this episode of the Money Metals Midweek Memo. You can get more information about everything I've talked about on the show today and a whole lot more over at moneymetals.com/news. And if you want to get the latest news and information relating to gold and silver right in your inbox, join 1 million other people and sign up and get on our email list. Now, of course, you can subscribe to the Midweek Memo on your favorite podcasting platform. And when you do, you'll also access our Market Wrap podcast that runs every Friday, where you're going to get a quick overview of the week in precious metals, along with conversations between yours truly and interesting people from the world of gold and silver. This week, I'll be talking with Axel Merck, who's a very interesting analyst. So check it out. Thank you so much for listening to the show. As always, I appreciate it. I know there's a lot of stuff out there that you can be listening to, and thank you for choosing to spend a little bit of time with me. That's a wrap for this episode. I will be back again behind this microphone next week.
Okay, I want you to do something for me. I want you to close your eyes for a second and just picture a room. It's not, a comfortable room. It's dark. And in the center of this room, standing on the left side, is Thomas Paine.
Thomas Paine. Okay.
Yeah.
We're starting with the heavyweights. I like it.
Absolutely. I mean, the man who wrote Common Sense, the intellectual architect of the American Revolution, he's standing there in his 18th century coat, looking very serious, very intense, a man who spent his entire life thinking about liberty and tyranny.
A giant of political philosophy, for sure. You really don't get much bigger than Paine when it comes to the foundations of, the modern West.
Right. And standing across from him, staring him right in the eye, is a 10-year-old girl from rural China. She's wearing a hoodie, maybe holding a smartphone. She's just a kid, a primary school student.
I have the image. It's quite a contrast, the revolutionary and the schoolgirl.
So here's the question I want to pose to you and to everyone listening right now. If you had to hand over your life savings to one of them, or better yet, if you had to pick one of them who truly understands the mechanics of the global economy as it stands today, right now, in February 2026, who do you choose?
Wow. That's a loaded question. The knee-jerk reaction, obviously, is to pick the founding father. He's the intellectual. He's the statesman. But knowing what we're diving into today and knowing the absolute chaos we are seeing in the markets right now, I have a sneaking suspicion you're going to tell me the smart money is on the 10-year-old.
You would be absolutely right. And that is exactly what we're unpacking today. We have a massive stack of reports, data, analysis, all from Money Metals, and we are going to do a deep dive into a battle that is raging right now. A battle between, as we're calling them, paper tigers and silver beans.
Paper tigers and silver beans. It sounds like a fable, doesn't it? But we're talking about the very real war between paper money and the paper markets that trade it versus sound money, specifically physical gold and silver.
And we are doing this in the context of a very, very wild month. I mean, if you've been watching the markets at all, your jaw is probably still on the floor. It is mid-February 2026.
It's been a historic month. I don't think that's an exaggeration.
Not at all. Silver hit $120 an ounce just last month, an all-time record. People were popping champagne. And then almost as fast as it went up, it corrected back down to the $75 to $80 range.
Which is still, historically high. But that drop, that represents the massive amount of volatility. Whiplash is the word.
Exactly. People are getting whiplash. So the mission for this deep dive is to figure out What is actually happening? Why are the global vaults draining? Why is the West, it seems, losing control of the price mechanism? And maybe most importantly, why is a 10-year-old girl in China making better returns than most hedge fund managers on Wall Street?
It's a fascinating story because it's not just about charts and graphs, is it? It's about trust. It's about that moment the world realizes that the paper promises we all trade,
Huh?
well, they might not be worth the paper they're printed on.
So let's start with the philosophy. Because to understand this 10-year-old girl and to understand why silver is behaving the way it is, we actually have to go back. We have to go back to the 18th century. We need to talk about Thomas Paine's warning.
Absolutely. Most people know Paine for his political writing, advocating for independence from Britain. But he wrote this devastating essay specifically on the nature of money that is, frankly, just eerily relevant to our situation in 2026.
Eerily is the right word.
He had this very simple, very cutting distinction. He separated money into two categories: emissions of nature and emissions of art.
Emissions of nature versus emissions of art. I really like that phrasing. It sounds almost biological, doesn't it? Break that down for us.
So emissions of nature are things like gold and silver. They're geological. Paine argued that their value comes from a source completely outside of human control. We can't just wish more gold into existence. We can't pass a law that says there shall be more silver.
Right. We're stuck with what the earth gives us. It's a physical reality.
Exactly. Paine wrote, and I'm paraphrasing a bit here, that man has no share in making gold or silver. All we can do is labor to find it, to dig it up, to refine it, and then to stamp it. But the quantity, that's determined by nature.
And that's the key. That's a natural constraint. It's a check on power.
It's the ultimate check on power. And then you have emissions of art.
Which is paper money.
That's paper money. That is a human invention. Paine called it an invention of man. And because it's an invention, it lacks the one quality that is absolutely necessary for real trust: scarcity.
So his whole argument was that paper is it's too plentiful and too easy to come by. You can produce it for a trifle.
A trifle. I love that word. Basically, the cost of ink and paper, or in our modern case, the electricity, to type a few zeros on a computer screen at a central bank.
It's nothing, a keystroke.
It's literally nothing. And because it's so easy to create, Paine argued that government paper money is a fundamental fraud. He didn't mince words at all. He called it a scam.
A scam. Wow.
He believed that no matter what laws you pass, you cannot turn paper into money. As he put it, and this is the killer quote, "Money is money and paper is paper. All the inventions of man cannot make them otherwise."
It's amazing how brutal that is. All the inventions of man cannot make them otherwise. It's like he's yelling at the Federal Reserve from the grave. But help us understand the why here. Why did he think it was such a fraud? Was it just because it was cheap to make?
Well, it's not just the cost of production. It's about what that cheapness allows governments to do. This is where we get into the concept of the inflation tax.
Okay, let's unpack that. The inflation tax.
Think about it this way. If you are a government and you have to dig gold out of the ground to pay for things, your spending is limited by geology. It's finite. So if you want to fight a war or build a massive welfare state, you have to tax people directly.
You have to take physical coins from their pockets.
And people generally hate taxes.
Mm-hmm.
If a tax collector comes to your door and says, "I need 10% of your income," you're going to feel that. You might slam the door in his face. You might vote the government out.
It's visible. It's painful.
Precisely. Direct taxation is visible and it is painful. But paper money allows for the inflation tax. The government can just print the money they need to pay their bills. They don't have to knock on your door. They just dilute the value of the dollars already in your pocket in your bank account.
It's the stealth tax.
It is. It's theft,
Yeah.
but it's quiet theft. You don't notice it immediately. You just notice later that your grocery bill is higher, or your rent is up, or gas costs more. Paine saw this centuries ago. He realized that big government dreams are impossible with sound money. You need the printing press to fund the unfundable.
So fast forward to today, February 2026. We clearly did not listen to Thomas Paine.
No, we did not. We did the exact opposite. We went all in on emissions of art.
We've built an entire global financial system on paper. But it's not just the currency, right? This is where it gets really interesting to me and where our deep dive really starts. It's not just that we use paper dollars. We've turned the gold and silver markets themselves into paper markets.
And this is the crux of the problem we are seeing right now. This is the paper tiger. When you hear people talk about the price of silver, usually they aren't talking about the price of a physical bar you can hold in your hand.
Right, they're talking about something on a screen.
They're talking about the price of a futures contract, a derivative, piece of paper.
A promise.
Exactly, a promise that says, I will deliver this much metal at this date in the future. And for a long, long time, that worked fine because most people in the market are just speculators. They don't actually want 1,000 ounces of silver delivered to their living room.
No, it's heavy. It's a pain to store.
It's a huge pain. They just want to bet on the price going up or down. So they trade the paper back and forth.
They trade the promises, like baseball cards.
Right. But here's the terrifying statistic from our source material, specifically from an analyst named Faisal Amin. The ratio of paper silver to physical silver is staggering. It is nearly 356 to 1.
Wait, hold on. Say that again. Let me make sure I'm digesting that. 356 to 1.
356 to 1. Yes. For every 1 ounce of actual physical silver sitting in a registered vault, there are 356 paper claims floating around the market.
That's insane. That's like a game of musical chairs where there is one chair and 356 people circling it.
That is the perfect analogy. And as long as the music keeps playing, as long as everyone is happy just trading the paper contracts, nobody actually tries to sit down in the chair, the system looks stable. It just hums along.
Sure.
But the moment the music stops,
the moment confidence erodes,
the moment people start saying, you know what, I'd actually like my silver now, please. The whole thing collapses. You have 356 people diving for one chair.
And that's the bank run scenario we always hear about.
It's exactly that. It's fractional reserve banking on steroids. And what we are seeing in early 2026 is that the music is starting to stutter. People are starting to ask for the metal.
And this isn't just some, theoretical doom mongering. We have hard data on this. Let's talk about the COMEX.
Right. The COMEX, the primary futures exchange in the U.S. It's the heart of the paper market. And we track their inventory levels meticulously. They have what's called registered silver, which is metal that is fully available to be delivered against those paper contracts.
That's the chair in the middle of the room.
That is the chair. And historically, you want a healthy buffer there. You want plenty of chairs. But as of February 11, 2026, the total registered silver at the COMEX has dropped below a major psychological threshold. It's under 100 million ounces for the first time in a long time. It's sitting at about 98.1 million.
Now, 98 million sounds like a lot to you and me, but in a global market,
it's nothing. It's a rounding error. When you consider the industrial demand for solar panels, for electronics, for batteries, and then you layer on top the investment demand, 98 million ounces is razor thin. It is a dangerously low number.
And it's not just the registered stock, right? There's another category.
Yeah, eligible silver. That's metal that is stored in the COMEX vaults, but it's not technically for sale or available for delivery. It's just being stored there by its owners. And even that is being withdrawn. We just saw 4.7 million ounces of eligible silver vanish recently, too.
So the vaults are draining. The owners are literally taking their ball and going home.
They are draining. And this is why prices are reacting the way they are. As Faisal Amin noted in his analysis, the price of silver isn't just reacting to simple supply and demand anymore. It is reacting to the realization that the market's underlying structure is no longer credible.
The 356 people are realizing there's only one chair.
And they are starting to panic.
Which brings us to the silver squeeze. We've been living through this for the last year or so. Walk us through the timeline, because this didn't just happen overnight. This wasn't just one bad week.
No, this has been building for a while. If we look back at the timeline provided by Money Metals, the cracks really started to show in the spring of 2025.
So about a year ago.
Right. There were a lot of worries floating around about tariffs and trade wars, and those tariff worries caused this weird migration of metal. Silver started moving out of the vaults in London and heading to the U.S. People wanted the physical metal close to home, within their own legal jurisdiction.
Okay, so the metal starts moving, it's getting restless, the pile is being shifted around.
Exactly. Then, in the fall of 2025, the dam broke. And interestingly, it wasn't Wall Street that broke it. It wasn't some hedge fund. It was India.
India. We are going to talk a lot about India today, I can tell.
We absolutely have to. We saw an explosion in Indian demand in late 2025. We'll get into the why in a minute, but the sheer volume was massive. That surge in demand is what pushed silver prices above $50 an ounce for the first time in years. That was the first leg of the squeeze.
And then it just kept going. It went parabolic.
It accelerated. By January 2026, just last month, we hit that incredible peak of $120. And the system went into what I call whack-a-mole mode.
Whack-a-mole. What do you mean? Just frantically hitting problems as they pop up.
That's exactly it. The West tried to solve the shortage by just shuffling metal around. They moved silver from Hong Kong to London to cover deliveries there. Then they had to move it from New York to London. They were desperately trying to plug holes in the supply chain to prevent a default on a contract.
But shuffling doesn't actually solve the problem, does it? Moving a box from the garage to the attic doesn't mean you suddenly have more stuff in your house.
No. And that is the key takeaway here. You cannot solve a fundamental deficit by moving the same insufficient pile of metal around the globe. It's like trying to cover a king-size bed with a twin-size sheet. You pull it up, your toes get cold. You pull it down, your chest gets cold. There just isn't enough sheet.
And we know there isn't enough sheet because of the deficit numbers. These numbers from the report, they just blew my mind when I read them.
The Silver Institute data is crystal clear on this. For last year, 2025, we saw a 95 million ounce deficit. That means the world consumed 95 million ounces more than all the mines in the world produced.
Wow. So we're eating into the global savings account.
We are draining the stockpile.
Oh.
And that was the 5th straight year of deficits. If you add up the last 5 years, the total deficit is over 800 million ounces.
800 million.
800 million ounces. To put that in perspective, that is equivalent to an entire year of global mining output. It's gone. It's been eaten up by industry and investors over the last 5 years. We are running on fumes. We are literally scraping the bottom of the barrel.
So we have a physical shortage. We have a paper market that is leveraged 356 to 1. We have vaults draining. Now, I want to pivot to the geography of this because you mentioned India, and the reports talk a lot about this idea of Asian dominance.
This is a major geopolitical shift in the silver market. For decades, London and New York set the price. They ran the paper game. They were the dogs wagging the tail. But David Morgan, who is a legend in silver analysis, says that era is over. He says physical demand is now exerting dominance over paper pricing.
He used a great metaphor in one of the reports. He said the retail investor used to be the flea on the dog.
Right. The flea being the small guy and the individual buyer, and the dog being the big banks in the futures market. But now the industrial and Eastern demand, the physical demand, has become so massive that it is the tail wagging the dog. The flea has become a giant.
And we can see this in the Shanghai Premium. I love this concept because it shows just how broken the market is. Explain the Shanghai Premium to us.
It's a simple price difference, but it tells you everything. Right now, if you want to buy an ounce of silver in Shanghai, you are paying about $10 more than the so-called spot price in London or New York.
A $10 difference, that's huge. In a normal functioning market, traders would jump all over that, right? Buy low in New York, sell high in Shanghai, easy money.
It's called arbitrage. And that's exactly what should happen. Traders should buy in the West, ship it to the East, pocket the $10 difference, and in doing so, the prices would equalize, the gap would close. But that isn't happening. The spread is staying wide.
Why? I mean, why would you leave free money on the table?
Because there is no metal to move. You can't buy the physical silver in London to ship it because the vaults are empty or the owners won't sell at that paper price. Plus, you have logistics issues and capital controls and all that. But the main driver is scarcity. The fact that the arbitrage isn't closing is a flashing red light that the system is broken.
It's like a store advertising TVs for $10, but when you show up, they don't actually have any TVs in stock. It doesn't matter what the price tag says if you can't get the product.
That's a perfect analogy. And the hunger for metal in the East is just insatiable. You mentioned India earlier. This is fascinating sociologically. In India, gold is culturally huge. It's how you store generational wealth as part of weddings, festivals. But gold has gotten so expensive, it's trading near $5,000 an ounce now, that the rural population, the poorer populations, they've been priced out.
So they are pivoting down the periodic table to the next best thing.
They're aggressively buying silver as the alternative store of value. And they aren't just buying little coins or jewelry. The demand is so intense that India is importing 1,000-ounce commercial bars.
Those are the big ones, the ones that look like doorstops.
These are the massive industrial bars usually reserved for the COMEX or for big factories. They weigh about 70 pounds each. Money Metals reported that they actually had to ship pallets of these 1,000-ounce bars to India because the retail products, the small bars and coins, just weren't available.
That is an incredible image. Pallets of 70-pound silver bars flying into India to meet demand from farmers and rural savers.
It shows you the desperation to get out of fiat currency. They will take the silver in whatever form they can get it. They don't care if it's an ugly industrial brick. They just want the weight. They want the real thing.
And that brings us to the big why. Why is everyone rushing for the exit? Why is the paper money losing trust so quickly? We have to talk about the I word, inflation.
The I word, the elephant in the room.
Now, if you look at the news, the official numbers, the CPI, the Consumer Price Index, came in at 2.4%. And the Fed is out there saying, mission accomplished. We are close to our 2% target. But our expert in the source material, Mike Maharrey, calls this deeply misleading.
It's gaslighting, essentially. First of all, let's just look at that 2% target. Maharrey makes a great point that I think flies over most people's heads. The stated goal of the Federal Reserve is to steal 2% of your purchasing power every single year.
When you put it that way, it sounds a lot less benevolent, doesn't it? We only plan to rob you a little bit.
That's 10% of your wealth gone every 5 years. That is the success scenario. But more importantly, the CPI is a flawed metric. It's a politically manipulated number. It measures price symptoms, not the disease. The classic Austrian economics definition of inflation is an increase in the supply of money and credit.
It's about printing money, not about the price of eggs.
Exactly. The price of eggs is just the result. And by the real definition, we are in a raging inflation inferno. The money supply is currently growing at the fastest rate since July of 2022.
But the Fed claims they're tightening, or at least holding steady. That's the public line.
They say that.
Yeah.
But since December 2025, they have been running what Maharrey calls stealth QE, stealth quantitative easing.
What makes it stealthy? Are they doing it in the middle of the night?
In a way, they aren't holding a press conference and saying, hey, everyone, we're back to printing money. They just quietly buy U.S. treasuries to support the bond market. Right. But they are buying those treasuries with money they created out of thin air. It creates liquidity. It pumps cash into the system without making a big announcement.
And why are they doing this? Why not just actually fight inflation?
Because they are trapped. They're in a catch-22. This is what's called the debt black hole. The U.S. government is so heavily in debt, we're talking over $36 trillion now, that if interest rates stay high, the interest payments on the debt become mathematically impossible to pay. The government would default. The entire economy would crash.
So they have to cut rates and print money to keep the government afloat.
Right. But if they cut rates and print money to save the government, then price inflation explodes and the currency gets destroyed. Yep. They have to choose. Destroy the economy with deflation and a massive debt default, or destroy the currency with inflation.
And looking at the stealth QE, it looks like they've made their choice.
They're choosing inflation. They always do. It's the path of least political resistance. It kicks the can down the road and lets them blame someone else when prices go crazy.
Okay, so let's just recap where we are for a second. We have a system that is fundamentally fraudulent, according to, of all people, Thomas Paine. We have a paper market that is leveraged 356 to 1. We have the East draining the physical metal out of the West. And we have a government that is secretly but actively committed to devaluing the currency to pay its bills.
It's a perfect storm. It really, really is.
Which brings us back full circle to our 10-year-old girl.
The hero of our story, the unlikely financial genius.
This is such a great anecdote from the research. So there's this girl in China. She started investing 3 years ago when she was 7 years old.
7 years old. My goodness. Most 7-year-olds are buying candy or video games.
And it all started with lucky money, right? The red envelopes kids get for a Lunar New Year.
Yes. She gets about 4,000 yuan a year. It was about $580. And at age 7, she had a realization that was just incredibly mature. She was afraid her parents were going to borrow her cash.
Which, let's be honest, is a valid fear for... Here, I'll hold on to this for you. Is the oldest lie in the parenting book.
It is. It absolutely is. But her solution was genius. She realized that cash is liquid. It's easy to spend. It's easy for her parents to slip a bit of it out of the envelope and say, oh, we'll pay you back later. But gold is sticky. Gold is hard to spend. It is a store of value. It's a real object.
So she started buying these things called gold beans.
These are a huge trend in China right now. They are small 1-gram beans of pure gold. They're very affordable. They're kind of cute, but they're very, very real. She started buying in at 460 yuan per gram.
And where is it trading now in February 2026?
It's trading at 1,100 yuan per gram.
That is. Let me do the math here.
It's a 139% return in 3 years.
139%. That beats the S&P 500. That beats almost every single hedge fund manager on Wall Street.
And here's the key to her genius. She didn't sell. Even when the price corrected in January, she held on. She actually told reporters that she plans to buy more with this year's lucky money. She sees the dip as a sale.
What I love about this is that she intuitively understands a very complex financial concept. She understands counterparty risk.
Exactly. She thought the risk was her parents. She didn't trust the authority figures in her life to manage her wealth. But the lesson applies to the whole world. The parent, in the macro sense, is the government. The government wants to borrow your purchasing power through inflation. They want to seize your value to pay for their mistakes.
And just like the girl realized, if you hold cash, they can take it. It's easy. It's just numbers on their computer. But if you hold gold, if you hold emissions of nature, it's yours. It's in your hand.
She is relying on geology, not on authority. She trusts the metal more than she trusts the people running the house. And that is why she is winning. That's the whole lesson.
It really puts the paper tigers in perspective. You have these incredibly sophisticated traders in New York and London with their PhDs and their algorithms and their 356 to 1 leverage, and they're getting wiped out by margin calls. And then you have a 10-year-old with a jar of gold beans just sitting there, up 139%.
It's the ultimate triumph of simplicity over financial engineering. Real things have real value, and paper promises eventually break.
So let's wrap this all up with some practical takeaways for you, the listener. We are recording this in mid-February 2026. The market is, to put it mildly, volatile. Gold is trading just below $5,000 an ounce. Silver is hovering under $80.
Now remember that $80 silver price is after a huge drop from 120. So there's fear in the market.
Right. So what is the outlook? The report mentions something I found really interesting about so-called junk silver.
Yeah, this is a weird anomaly that's happening right now. Junk silver refers to pre-1965 U.S. coins, quarters, dimes, half dollars that are 90% silver. Usually these carry a high premium over the spot price because they are recognizable, they're fractional, and they're great for a potential barter scenario.
So they're usually expensive.
Very. But right now, Money Metals is reporting that they are available below the spot price of silver.
Below spot? How is that even possible, given the shortage we just spent an hour talking about?
It is crazy. It suggests that maybe people are selling off grandpa's old coin collection to pay bills, because of price inflation. It's creating a temporary glut in that one specific niche of the market. Meanwhile, the big 1,000-ounce bars are vanishing. It's a fascinating disconnect. And frankly, it's a buying opportunity for the retail investor to pick up recognizable silver at a discount.
And what about the volatility? That drop from 120 to 75 scared a lot of people. Is the bull market over? Did the bubble pop?
It shouldn't scare you if you understand the mechanics. That drop was, in a way, manufactured. The CME Group, the exchange that runs the paper casino, raised the margin requirements.
Okay, what does that mean for the average listener in simple terms?
It means they changed the rules of the game mid-hand. They forced the speculators, the gamblers, to put up more cash to hold their paper contracts. When you raise margins like that, you force the leveraged players to sell because they can't afford the new higher ante. It flushes them out.
So it's a way to shake the speculators out of the tree. It acts as a kind of natural break on the paper price.
Exactly. It's a break on the paper rally.
Yeah.
But here's the crucial point. Does raising margin requirements solve the physical shortage?
No.
Not at all. It changes the paper price on the screen, but it doesn't create a single ounce of new silver in the vault. The deficit is still there. The Asian demand is still there. The 356 to 1 ratio is still there. Yep. All the fundamental problems remain.
So the advice from the experts in these reports is expect turbulence.
Volatility is the new normal. We are going to see massive swings, up $20 one day, down 15 the next. But the fundamental trend is driven by that physical deficit. As Mike Maharrey says in the report, they can print paper to their heart's content. They cannot print metal.
That's the bottom line. You can't print metal.
You can't print metal.
It's been quite a journey today. We've gone from Thomas Paine in the 1700s calling paper money a fundamental fraud, to the empty vaults of London and New York, to the frenzy in India where they are importing pallets of industrial bars, and finally to a 10-year-old girl in China with her jar of gold beans.
And the thread connecting them all is that simple, powerful realization that value has to be real. It has to be tangible.
It really makes you think. We spend so much time worrying about our bank balances, our 401ks, these digital numbers on a screen. We trust the system implicitly. We assume the chair will always be there when the music stops.
But the system is built on promises. 356 promises for every one real thing. That is not a safe bet. It's the definition of risk.
So here is the thought I want to leave you with today. If a 7-year-old child can figure out that cash isn't safe in the hands of authority, whether that authority is mom and dad or the central bank, Why do we still trust our life savings to a system based on paper?
It's a question worth asking yourself. Maybe we should all be looking for our own gold beans.
Look past the paper price. Look at the metal. Thanks for diving deep with us today. We'll see you next time.
Stay curious.
Legacy paper diverges from physical reality. Eastern banks drain vaults while a Western closed loop traps premiums, around $97 and about $173 out. Family offices hold just 2% metals. Institutional entry points to $8,000 gold and $230 silver with real security and physical possession. RSI 4.0 replaces ex-post litigation with ex-ante engineering, proactive code-based self-executing contracts where breach is impossible. A civil law notary acts as a sovereign node certifying animus, so intent aligns with automated execution, the law between the parties. Compliance becomes syntax. Basel III and FATCA enforced as code with on-chain document notary seal and jurat hashes gated by RBAC. Be value-centric. Trade ratios to stack ounces, use GoldBacks to bypass premiums, and never sell metal for dying currency. Run the ratio play and unlock liquidity via tokenized credit mining and non-recourse funding, while UTXO logic prevents double pledging and enforces awards instantly. Join the architecture of sovereign finance. Partner with Justice Fund and RSI 4.0 and verify the code.